Now, this relentless BRICS gold demand has driven the legacy paper market to an impossible to maintain divergent inflection point that can only be resolved by one of two events. And we've looked at this: either a massive bid only, T+1 margin call, spiking gold thousands of dollars higher, or far more equitably for the US, resolved by a more orderly US Treasury gold price revaluation. Now that global physical exchanges have become sufficiently liquid to benchmark a real supply gold bullion price outside of the CME LBNA ring fence, the stealthy gold revaluation process that already commenced directly after the BIS revalued gold has gathered sufficient global momentum to force the US Treasury gold to be competitively revalued. Once it's revalued, the US will want a stronger gold price.
Andrew Maguire says the real story behind the gold market isn't just price, it's purchasing power. Gold isn't skyrocketing because it suddenly became more valuable, it's because the dollar is quietly eroding. China and India continue to absorb vast amounts of physical gold and silver, often buying more than all Western ETFs combined. To Maguire, that isn't rebellion, it's self-preservation. Nations are gradually stepping outside a financial system built on US debt, searching for stability that fiat currencies can no longer guarantee. He points out that some US policymakers have floated extreme ideas, like selling off all of America's gold reserves to undercut China's growing bullion influence. But that's not realistic. The official 8,100 tons of US gold are likely rehypothecated, claimed and re-lent multiple times within the paper markets. Unwinding those claims would expose layers of leverage and probably send gold prices soaring instead of suppressing them. Maguire says another strategy under discussion involves tokenizing US treasuries into a kind of treasury stablecoin. The idea is to tie the dollar's digital future directly to US debt and make it the global settlement medium again. But China has already moved ahead with a gold-backed yuan stablecoin that's fully convertible into physical metal. Against that, a debt-backed dollar coin looks weak. Any country forced to accept it could instantly swap it for gold through BRICS-linked systems, effectively bypassing US control. In Maguire's view, this is the quiet reset underway, a global migration from paper promises to tangible value, 1 ounce at a time. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Of the many ideas that have been trial ballooned, other than adopting the obvious choice of revaluing US Treasury gold to market to partly back the US dollar with gold, which will actually be enormously beneficial for the dollar, let's examine the various possible official White House to BRICS pushback options. Now, what could they be? There's really basically a couple. It could threaten to sell all its gold reserves. These things have been discussed. They could threaten to sell all their gold reserves in an attempt to devalue China's BRICS influence. Really? Given that deliberately unaudited US Treasury holdings are to an unknown degree rehypothecated with double ownership claims. So in order to sell its 8,100 tons of gold to effect this pushback, the US Treasury would have to first buy back billions of related underwater Office of the Comptroller bets, which would spike gold even higher. It's too late. The horse has bolted, and the US is left holding less than 1/10 of what the BRICS collectively hold. Less than. So US gold reserves are literally far too small to actually push back. And another reason, and this is another one which we've seen in the past. I think Saylor talked about it. We had various other people in the past pushing back and saying, hey, well, why don't we do this? Especially with the stablecoin mandates being pushed out. So the other idea, and this is what we're going to look at, is that because it's been trial ballooned more recently, that the US Treasury may try to back its Now it's 38 trillion of debt. And that's just official. It's much larger than that. But let's just say they want to back its 38 trillion of debt with freshly generated dollar-backed treasury stablecoins. Now, however, and essentially what they're doing is that would attempt to devalue this 38 trillion of debt by forcing US Treasury debt on other global central banks. In other words, you got to use our stablecoin. However, this ignores the fact that the physically gold-backed yuan stablecoin is already one-to-one exchangeable for gold. And those being forced to receive these dollar stablecoins, trade with them, have the option of immediately squaring these debt-backed dollar stablecoins back into gold by way of instant settlement into BRICS, Russia, Chinese-led gold-backed stablecoins, thereby laying off this US dollar debt. I don't see it happening. I don't see it working. Now, this relentless BRICS gold demand has driven the legacy paper market to an impossible to maintain divergent inflection point that can only be resolved by one of two events. And we've looked at this: either a massive bid only, T+1 margin call, spiking gold thousands of dollars higher, or far more equitably for the US, resolved by a more orderly US Treasury gold price revaluation. And of course, all the liquidity providers, all the smart people are saying, well, of course, they're going to choose that option. So, yeah, you can trial balloon all this other stuff, but there's the reality of it. Now that global physical exchanges have become sufficiently liquid to benchmark a real supply gold bullion price outside of the CME LBNA ring fence, the stealthy gold revaluation process that already commenced directly after the BIS revalued gold has gathered sufficient global momentum to force the US Treasury gold to be competitively revalued. Once it's revalued, the US will want a stronger gold price. And as we've been drawing attention to, every single non-dollar denominated fiat gold price, pound, yen, whatever, euro, whatever you want to look at, has been dragging lagging dollar gold price into its all-time highs. They've all been into all-time highs way before gold did. And yes, we will see from time to time the US is able to push back the dollar gold price from time to time, as we likely see again today into gamed FOMC volatility. But it's limited to how much COMEX derivative open interest can be laid off against a dwindling number of speculators siloed outside the real market price setters. They don't even know what that price is. And as we've been focusing on, the real game changer is that China took off the gloves the moment the yuan gold became fully Basel III compliant, and opening up Western-facing institutional grade one-to-one ability to one-to-one vault their bullion in vaulting facilities, which are able to eliminate unallocated gold counterparty risk.
Andrew Maguire says China has effectively taken control of the global gold and silver markets. The current rally isn't being fueled by speculation, it's being driven by real, physical demand. Supply is tight, and buyers are taking delivery rather than just trading paper claims. That shift marks a major turning point. Gold has become the only truly liquid asset with zero counterparty risk, and that's why central banks, sovereign funds, and major investors are migrating toward physical exchanges, especially those tied to the Shanghai Gold Exchange. Maguire explains that both gold and silver are moving into stronger hands as speculative players get flushed out. Momentum traders who bet purely on price direction are getting caught off guard, while large commercial participants quietly add to their physical holdings. Market makers have tried to engineer a bearish head and shoulders pattern to trap traders into short positions, but it hasn't worked. There's simply not enough open interest in the paper markets to suppress prices anymore. He says the power dynamic has shifted. The physical market now sets the tone, not the futures market in New York or London. That's why this rally feels different. It's being anchored by real metal, not leveraged speculation. Let's get back to the interview.
Has usurped gold, classifying it as the only liquid, zero counterparty risk, high-quality liquid asset. And that is why global central banks, alongside sovereigns, Western-facing institutional investors, and borrowers, are being onboarded at unprecedented rate into SGE physical-backed exchanges. The CME LBA wonder why this liquidity is disappearing. And what does it involve? It involves selling dollars to buy gold. China has now gained full control of the physically settled gold price setting mechanism, and to accommodate Western-facing participants who are in the advanced stages, they're opening up the Western-facing global gold corridor. We can all access it. Investors can buy and pledge high-quality liquid asset gold in Hong Kong, in Singapore, and then you've got the SGE is opening up vaults in Zurich, Dubai, multiple cities in Africa, South America. I mean, it's done. They've usurped the entire gold market. So circling back to very short term, gold and silver are rapidly moving into strong hands with very large short stops layered above the market and naked long momentum specs rinsed, and commercials one-to-one taking the long side of freshly retrenched naked shorts. You can see them active. They're trying to fight this rally. Momentums do not like sideways action. They want a direction, and they will be wrong at both ends. And once again, that's exactly where we are in this process. So I think what our liquidity providers are simply saying, look, this physically driven gold rally has simply paused mid-rally, with fresh 2026 targets being assessed as high as $8,000. Now, they've deliberately constructed a bearish head and shoulder structure, which is a classic bearish structure that technical traders may either try to create, if you're a market maker or a cartel, and you've got control of the futures markets. But this head and shoulders pattern was really designed, or really will have emboldened momentums to go short. So we still may get the odd pullback here. And that's nothing, or the short-term overshoot of what is really very, very strong physical support. But this would require a lot of fresh naked short supply, and there is not enough open interest. In other words, COMEX chips for the COTs exposed, the commercials, exposed to T+1 delivery obligations to hedge against this purely synthetic structure. And we saw them attempt the same thing in silver. But again, for the same reasons, there isn't enough open interest, derivative open interest, against physical demand for them to be able to. This is no longer just a synthetic marketplace. The prices are being set outside of the COMEX. And just based on this alone, you only have to listen to mainstream media. You only have to listen to those with a vested interest for the gold price to go down. All the usual suspects are calling for a deeper correction. At best estimate, looking at the paper to physical structure, we figured the momentum-driven naked short overshoot may have had sufficient momentum to briefly breach the gold futures 39 level, which it didn't. It was only $1.50 above that. Bearing in mind that futures traders are, and those exposed to physical delivery, T+1 delivery, will be long gold futures to hedge any kind of breach of 3,900. And we figure by this point, even the most bearish projections will have been exceeded, and commercials will be actively hedging physical exposure, which is what we see at the moment. If you're a stacker, and I know most of you are, This opportunity to convert depreciation debt-based fiat into physical gold and silver at these deeply underpriced pivot points, that's what we're witnessing here, will be seized on wholeheartedly.
What's unfolding in the gold market right now isn't just a price rally, it's a transfer of power. The dominance once held by Western trading hubs is slipping, and the balance is moving toward regions that actually take delivery of metal instead of betting on paper. China and India aren't speculating, they're securing real value in a system built on credit and promises. That shift is forcing the rest of the world to confront an uncomfortable truth. The dollar's strength was always rooted in trust, not tangibility. And that trust is eroding. The conversation around tokenized treasuries and digital currencies only highlights the divide between financial engineering and physical wealth. One side is trying to reinvent the same debt-driven model. The other is anchoring its future in assets that don't need anyone's permission to hold value. This quiet migration toward tangible reserves marks a deeper realignment of global finance. Central banks, sovereign funds, and even private investors are realizing that paper claims can be created endlessly, but gold cannot. Every ounce leaving Western vaults and landing in Asian hands represents more than trade. It's a vote of no confidence in the old order. As the world edges closer to a settlement system backed by real assets instead of obligations, the question that hangs over everything is whether the West will adapt to this new era, or keep clinging to a financial model that's already losing credibility. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.